First up is Bruce Norris. Bruce Norris is the president of the Norris Group. He's been a real estate investor for over 30 years, builder, hard money lender, and let's welcome him to the stage.
Thank you for that massive round of applause. We miss seeing you guys, but this is an important day. It's one of my favorite days because I think all the panelists are experts in their field. And it's a big deal because there's questions I always want to ask. And so some of the questions that you'll hear after we're all done doing presentations will be mine because I'm really curious about some stuff. As most of you know, I've been a real estate investor since 1980. And in 1995, so 15 years after I started being an investor, I had an interesting experience. I bought my son Aaron a Honda Civic for graduation. I think I paid $15,700 for the Honda Civic, and the only reason I ever remember that is a couple days later I bought a 3-bedroom house in Riverside for $13,300. And after 15 years of being an investor in real estate, I realized that I have no idea what makes prices move up or down. And I thought maybe I would like to figure that out. And first of all, I tried to see if somebody else had figured it out. I looked at all the statistics for 25 years on microfilm. Anybody that wrote an article about price changing in real estate, I looked it up. And no one's ever said in the future, this is how it's going to look. So I decided to try to figure that out. And so we did a report in '97, California comeback, why prices will double in the next 8 years. And so ever since then, I've made my real estate decisions by looking at statistics, setting up things that are earmarked, say, okay, when that happens, then these things follow. So this morning, for the time that I've got, I wanted to ask this question. Are the important stats in 2020 superior to 2019? Because we certainly have a different reaction in 2020 than we had in 2019. When we did a live seminar in 2019, I was looking at the best stats I'd ever seen. And by that, we should be off to the races. Our prices, historically, with the set of charts that we had, could have easily gone up 10 to 15%. We had no foreclosures to compete against. We had reasonable inventory. We had very high affordability. We had tremendous employment. Everything that was a green light produced almost nothing in 2019, and it was a head scratcher. And then I really thought, okay, well, if things turn negative, if you can't go up with this set of charts, what's going to happen when something turns the other way? Well, 2020, you have to say, kind of turned the other way, and it was a little bit of a different reaction. So let's take a look at what was 2019 versus 2020. In 2019, we had an unemployment number that was below 4%. It was 50 years the best chart ever. Unemployment was so low. And then, of course, we had the pandemic hit. And unemployment went crazy, almost into Great Depression level numbers, and gradually have been improving. But the thing that concerns me about 2020 are the number of unemployment claims that are still being filed. So if you go back to 2019, and it was a very consistent thing even for a decade before that, you have an average of about 220,000 filings weekly for unemployment claims. And we're now down all the way down to 709,000 the last week in November that they kept record of, and we had gone up to 6 million. So is that an improvement? 2020 versus 2019? I don't think so. And I just look at that and go, okay, wow, I'm really surprised. GDP growth, you know, we had mild GDP growth in 2019. Our GDP totaled 21 trillion, 0.43, up 2.3%, I think. What do you think is going to happen at the end of the year with the totals for 2020? It's not going to be positive. It's going to be negative, that's for sure. So we have unemployment that's worse. We have GDP, an economy that's not doing as well. Our federal deficit is now going to be screeching forward. It's already gone up over $3 trillion this year. And who knows what's next. As most of you know and attended, we had a report a couple years ago that seemed a little idiotic, 2% mortgage rates and $40 trillion in debt. And I'm sorry to say we're going to reach both of them, all probably for the wrong reasons, but I got an email from Rick Solis a couple of days ago, and he said I couldn't resist, so he refied his residence and got a 2.8% loan. So I guess the question, and also migration, there's a lot of people now leaving California, so that's not a positive thing either. So a lot of charts that matter are much worse in 2020 than they were in 19. And what about the certainty? How do you feel about what's next? In 2019, if you looked at the job situation and unemployment, you had confidence that you were going to have a job. In 2020, you have to feel very differently about that. Foreclosures were not a participation at all in the marketplace in 2019. There's some people that are concerned about foreclosures rising. I can't say that I'm in that camp. I think it'll be prevented by policy or by an improvement, but it's still an uncertain category that wasn't around in 2019. What is certain is probably going to have some tax policy changes that could have ramifications for real estate. So when you start comparing how wonderful 2019 stats were versus the uncertainty of 2020, I'm a little astonished that this is the end result between the 2 years. California sales are up 21.2% 2020 versus 2019. Which is kind of astonishing because if you take a look at this chart, in 2009 we had our last really pretty stellar year in sales. And how did we induce that? Well, prices were about half, and that wasn't good enough. We gave people an $8,000 tax credit to buy something. So that's why you had volume of sales. Now we're up 80,000 sales, and you have a set of charts. This sort of defies logic. Your unsold inventory is down 45%. And what's interesting about that, by the way, I'm going to go backwards. The reason that was given that 2019 and 2018 sales were low is that we didn't have enough inventory. Well, that's interesting. So now you have 2.5 months of inventory and you have sales up to 480,000. The two don't go together. So all of a sudden, we have very low inventory, we have sales up, and we have a median price that's decided to take off. So going back to 2019, with the best set of charts that I had ever seen, April to December in 2019, this was the price range. And a lot of times you have movement within a year. You have a peak in August. Well, we really didn't have much of anything. 603 to 614, you had less than a 2% movement, again, with the year that had these great charts. In April 2019, this price was 603. April 2020, 606. It had moved 0.5%. So that's where we stood April of 2020, and the number of 712,000 comes from September. So from April to September, we've managed to go up 17.5%. I hope you've asked yourself why, because I can't figure it out by using charts. And that's one of the things that's really kind of confusing for somebody like me to look at this and go try to figure out what is driving this. Because I think it's important to understand, because if it's going to continue, okay, but we better understand why. And I'm not sure I'm going to come up with it today. And while we were, before the event, I was talking to people that are on the panel, why do you think this is going on? And so it's just interesting. One of the things, of course, is, we got these great interest rates. So you have 2% mortgage rates or something that starts with a 2 for the first time. Well, how does that translate to the market? To me, it translates in affordability. So how's affordability? In 2019, third quarter, it was 31%. 2020, it's 28%. Now, why did that happen? Well, you had a $100,000 price increase. So that took out the affordability. But the momentum in the third quarter for 2020 is far superior to the 2019. So high affordability is still there at 28. It was definitely there at 31, but with no market reaction. So I can't land and say, okay, wow, it's those interest rates that are driving everybody. Now, it has a side effect. And so this is what I think might be going on. The coronavirus, when it came about, what happened to the listings, there was a lot of removal of listings. That's the first thing that occurred. I think, first of all, there was a relocation urgency from one group. So maybe your living situation, you realized, okay, this is now dangerous. I live in New York. So I don't live in New York, but let's say if you live in New York, I can tell you people that are coming to Florida are most often from New York and New Jersey. They are leaving the tightly packed population. And if you've ever been in Manhattan, that's all there is. I mean, you come out of your condo and walk into, you go to you live in a 5-block radius of every store repeats itself, and you get on a sidewalk in New York, you're packed. It's no way to, how do you avoid, how do you have social distancing on a subway? It's crazy. And I think you just opt out of that. So I think there was relocation urgency. And when that happens, and especially you come from a high dollar area to an area like Florida, I can tell you as a buyer in Florida, everything's on sale. So when my wife Sandy and I decided, okay, we're going to make that move, price wasn't the big determination. We wanted the home that we could find. We found it in 3 days. And we were the seller's dream come true because it didn't matter. We wanted that. It wasn't like we negotiated, we just bought it. That happens. People come from more expensive areas, but if they have this relocation urgency, they want to make a decision. That's unusual. That's what I think got kicked off. At the same time, you had let's hunker down and stay here. So what happened to your inventory? It got pulled off. It didn't necessarily show back up. I don't know that it's going to. What if you got to refi your house at 2.5%? Have there been maybe a group of people that said, let's just stay. Let's never leave. And so at the same time of you have this urgency to move and buy, you've had this, I'm afraid, and I'm going to stay, and I'm going to refi, and we'll just remodel, and we'll stay here. And I think the low interest rates compounded the shortage of inventory by having people refi and just stay instead of sell. So I think that's part of it. I think this coronavirus has created an emotional impact that has trumped charts. It's not that we didn't have good charts in 2020 at the beginning, but you could see in the beginning of 2020, we had no price movement. We had no price movement in 2019. And now all of a sudden you're up 17%. To try to make sense of that, you have to start thinking about, okay, why are people making these decisions? So as a real estate investor, here's a really good question. Is the rise in California real estate prices, is it real? Is it sustainable? And is it just the beginning? Because all those things really are at play right now. How could you not go up in 2019 and go up in 2020? If that's based on an emotional impact, is that emotional impact going to have sustainability? Is that what's going to take over the market to where we have a lot of people making decisions going from this area to this area, this type of inventory to this type of inventory? And so when I say, is this just the beginning, California has a history of getting to 17% affordability, and we're nowhere close to that. So it's really an interesting thing to me because I know that more people are leaving California than are coming here. And I know that the only way population is gained in California is the number of births outnumber the number of deaths, period. We are losing adult population, and yet we're in the middle of a 17.5% price increase in 6 months. So it's a head scratcher. And do I have all the answers? I don't. I've thought about it a lot. But I think it does come down to this is an emotional decision. If the emotion stays in place, this is probably going to be sustained. When you're in a state like Florida and you're the recipient of these people, I can understand the urgency and I can understand the price difference is sometimes big enough to where you don't care what you pay for it. But I also see that in the California market. I just had a small house sell, and the offer was over listing price, and then the person even put in the addendum that if it doesn't appraise, it's okay, I'll make up the difference. Now that's a motivated buyer. In other words, they probably got beat out on the last 10 houses they tried to get, and they want one that bad. So that's what's going on in the marketplace. So what's next? I am going to pay attention just like you. And I thank you for your time this morning.